one of the things that you're going to have to leave yourself some budget to make sure that you're happy with that continued assessment. If it's all quarantined in the past, then generally speaking, so long as it wasn't done in a slapdash manner, you can leave it to the past. But oftentimes these things straddle a few years. Similarly, where there's or in particular, where there's a joint venture arrangement or development agreement structure where you've got the more, that maybe the previous landowners, that might have been a farmer, and there's been rezoning in the area, so they've had an associated entity undertake activity to get some approval for property subdivision. So the historic landowner remains passive. A more active bit of activity has gone on in the structure. Those sorts of things, again, documentation. It's quite important there. Moving on, some of the other things that we're seeing, and I think the payroll tax area is probably more active at the moment in employee v contractor, absent or ignoring superannuation. I think the SGC area is quite active from that generally, but when I started work 35 years ago, it was one of the first things that I was asked to look at, as to employee v contractor. And I don't think in 35 years' time, unless there's a major change in rule, that we're going to be ignoring it. It's going to be continuing to be a significant issue. Labour payments. So if you look at an entity and there have been some payments for labour made, well, that needs to have some, PAYG and superannuation consideration. So I had one the other day where someone had gotten used to, because there was a car owned in a director's name, that they just paid a so-called allowance to cover the motor vehicle claims that were being deducted in a director's hands. And it was a mere allowance, so we didn't have to worry about any PAYG obligations, did we? Well, maybe that's not technically correct. And now that we're in a single touch payroll regime, unless you comply with all of that, then you're not going to be able to claim a deduction for that allowance that's been paid. So that's something that something to be mindful of. The other thing since July 22 is, especially at the smaller end, there's some people maybe that haven't kept up on the change that the de minimis threshold for super guarantee is no longer there. From the deductions side, prepayments, they need to be carefully considered, because sometimes, depending on whether or not you meet the sort of relevant conditions, they might not be immediately deductible. So that needs to be looked at. The other is where there's no income, but we've got some finance costs coming through. So there may well have been some old arrangements in place in an entity, an asset sold, there's still a liability that is owing, which they're continuing to meet those costs. No more income, so the question is whether or not that remains to be deductible. We see that coming through sometimes. And where you're taking over a client, you don't know the history. It could be valid that that it is in fact deductible because of the history of that particular entity, or it might be something that someone took a shortcut on and didn't assess it properly. So something you need to get assurance of. Another thing that's always good to have on your sort of query list is whether or not there were any private binding rulings that had governed the group. There's one client that I know that we've got that had a has an old ruling that's still current today, and if another advisor took over that client without being briefed as to the detail of that private binding ruling that was entered into in 2010 or 2011 or thereabouts, they would not be able to do a proper job in managing the client's affairs if they weren't sort of aware of the conditions of that ruling. So it's something to at least have in your query list for new clients. So I think I've mentioned that problems are inevitable, and the thing I liked these three quotes when I was sort of putting the presentation together. I particularly like the last one, and I think as advisors to sort of the SMEs, there's always a person on the other end of a problem. And we get our smelling salts, I guess, when we're confronted with a problem. That's when we really start thinking and start devoting ourselves to the issues. So we've got problems. Let's work out how we deal with them. So we've taken on the new client. I think the pathway to managing whatever the issue is could be quite numerous, and it really just depends on what it is. So the first thing I think you need to ensure is that your own engagement terms are sufficient to cover the dealing with the any issues that arise. And if you may have had a general retainer at the commencement of the engagement, something's come up, I think it's always useful to be specific as to, especially when you agree what you're doing and maybe what you're not doing in relation to an issue that comes up. As I've mentioned on the slide there, I think it's important to go into a bit of a triage mode. So I think there's we never make assumptions. So if we identify that there might be a problem, that doesn't necessarily mean that the problem is actually a crystallized one. It might simply be that the client was not aware of the importance of a particular document that was already in place, or it might be something that the previous advisor had, or maybe a third-party lawyer had handled a particular matter, and it was all dealt with appropriately. So you have that discussion around, well, here's what we see the issue is. We're trying to work through it, and then you determine who's involved. And by having that conversation with the client, and they can say, right, XYZ law firm actually helped me with that issue, or I had a similar thing in the past, and let's go and deal with them. It could actually be something where they would identify that there's been a lot of work done by the previous advisor, and they may well wish to go back to the previous advisor to assist in relation to addressing the problem. The way that you deal with it, I guess, is going to be influenced by, what the consequences are. How much is it worth? What's the risk in terms of penalties and interest? I think if it's a matter that relates to family trust elections and interposed entity elections, the default is that the interest cost might be quite significant. So, especially if there's quite some time involved. So that's something that would need to be considered. The other problem is, the availability of facts. So, where, an example might be you've identified a problem, and for instance, it shows that there might have been a loan balance that didn't move across quite a few years. Well, if the people are no longer around that were working for the company in 2016, then maybe it's going to be really difficult to solve the problem. The other thing here, and let's put our comments aside, aside in relation to the TASA changes. We do have a self-assessment system. Generally, returns are open for reassessment for 4 years or 2 years if it's a small business taxpayer. So you sort of let the punishment fit the crime up, perhaps. If the amount is quite significant, well then I think you need to be encouraging them to whether they're going to address it in the sense of taking it to the ATO, or at least taking it to maybe a barrister or legal advisor, just to try and confirm their position. But of course, if there is something of significant, then generally speaking, if someone takes a matter to the ATO without being prompted, so it's complete voluntary disclosure, then that more likely puts someone in the position where they're going to have penalties remitted, either partly or in full, and that's something that that would be part of assessing what the action might be. And I'll come back to the managing the new tax agent's risk, but in terms of the the amending of prior returns, technically what you're doing there is you're actually objecting and by lodging in a sort of amended return, you're technically sort of objecting against the prior return. So there's if everything's straightforward, then I don't think there's too many things to concern yourself with. But if it is a more complex matter and there might be some other issues that you've got to be careful of in terms of preserving a client's position, then it should be very carefully dealt with, and not necessarily dealt with via amending a prior year return. So we've done our triage, and the client has said, okay, I agree, there's a problem there. We need to deal with the ATO in relation to this. So, I think that is a process that needs to be carefully planned, and the better, more best preparation and in these matters, thinking about all the possibilities, is going to put you and your client in the best position. So the first thing is, who's the right person to manage this ATO engagement? And it might not be you. The previous advisor might have a better capability because of their access to, for instance, information, previous history, etc. Maybe they're a better person to deal with it, or maybe a lawyer. So it doesn't necessarily need to be you. If it's a previous agent, with all the horrors of agent linking and whatever, that's might be an interesting one, especially given that you've probably just gone through that process to get them on your system. It continues to be a bit of a problem there. One of the things here is relative certainty, like a little bit like that adage of like you don't ask a question unless you know the answer to it. If you have relative certainty on it, then I think it's easier to plan your ATO engagement than if it is significantly uncertain, especially if the uncertainty, one of the pathways could lead to a significant cost. So that one would be mindful of. The other one, and I've mentioned 109RB there, so in relation to some matters where you find a problem, there are some specific provisions where the Commissioner could be given certain discretions, such as in relation to Division 7A, in terms of inadvertent, honest mistake and inadvertent omissions, although it isn't easy to get those these days. The time left in the amendment period, having a casual approach to the ATO when we're flagging this issue and we'll provide further information in the next 30 days. If there's only 40 days left in the amendment period, you might not get a lot of joy out of the ATO in that example, unless your client is willing to provide an extension of time in relation to amendment if an amendment is required. But I think the idea is you want to think about the ATO's role in helping this be a constructive exercise of engaging with them. How good are your facts? If you're going to have a dealing with the ATO and you don't have all the information, it's going to be very difficult to have a really constructive engagement with them. And I know there's been some changes in relation to Section 99B and how the ATO deals with them, but before those changes came through, I can think of a few situations where we had difficulty, and in particular here I'm talking about where there might be some foreign deceased estates or foreign testamentary trusts, and there's just simply not enough information available. And it makes it difficult to, if there's a few years of financial information that are missing, to have the Commissioner be able to help you. The best information leads to the best outcomes. So I think in summary, you want to start the conversation as early as you can, and that might mean an early engagement process before you even go to more detailed step. And in that regard, you might just be after some informal ATO advice rather than needing the certainty of a private binding ruling. So if your client would need to, your client would know whether or not they want absolute certainty and protection, or whether they're willing to accept something lesser than that. And for instance, I mentioned deceased estates. You might have trustees of deceased estates might want a private binding ruling versus another type of trustee or another type of taxpayer might be happy to have a less formal ATO advice. I note there as well facts versus assumptions, and sometimes people are seeking, I need the certainty and the protection of a private binding ruling, but there's not enough information that would enable something at the evidence is not going to be at the standard as a private binding ruling requires. So it might be only some of the information is available, so you need to work on assumptions, and that would mean that the best you're going to do perhaps is to get a lesser, a less formal response from the ATO in relation to the matter. So in terms of obstacles and uncertainties that are inevitable, one of the issues of that does arise is where you're not properly informed or not properly briefed, and you know, that can be problematic. And one of the things that, I have mentioned a few times when I've spoken about these issues is don't like it's important that we don't jump to conclusions about the conclusions that a previous advisor has made. And you might have spent an hour or two looking at what the client's provided you, but the previous advisor might have spent 2 weeks on it and have a lot more detailed information, and therefore has a lot more background and support for the conclusions that have been adopted in the previous returns. So I think as advisors, we just keep asking questions, and in the end, we need to make sure that we've got the as fulsome information and documentation about the particular matter as we can. There's always going to be differences of opinion, and that doesn't necessarily mean that there's a problem, and even whether it's pre-TASA amendments or post-TASA amendments, it's the question as to whether or not the duty of care has been met, whether or not there's a reasonably arguable position for the particular matter. Whether you are comfortable with it, with the conclusion or not, you could very well be comfortable with the approach that was adopted, and that the documentation was enough to support the conclusions made. Going back to documentation, well, the warning flags, well, sorry, the records were lost in the flood, were lost in the storm. That's the dog ate my homework example. So you'd be very careful when you're raising something if the defence is, sorry, I've got nothing to support that because the records were destroyed or lost or whatever. The other one, in the system validity claims, every now and then something, when you start having a conversation with a new client, this happens thankfully rarely, but this so-called sovereign citizen movement and people querying the validity of the Australian tax system and the ability of the Australian government to impose taxes. Every now and then someone might flag that. I would say that's a very good example to run a mile, because you're not going to get joy looking after those clients. The particular professional standards, 110 and 220 noted there, so we should always go back and look at those. Also, terms of engagement, 305, need to look at those. PI insurance, I can think of, most recently, the most recent example was, I think, around 2016, or it might have been a little bit before, when there was a few PI insurers or underwriters, at the bigger end at least, started making noises about whether or not they were going to cover any liabilities that accountants incurred because of Part 4A being applied to a particular matter. Now, they seem to have gone away, that it sort of hung around for a year or two, but then but Part 4A is part of our system, so I think they accept that. But it highlights that we've got to be very mindful as to what our PI insurance says, what are the exclusions, and if we do identify that there have been some problem issues in relation to the past, then we should maybe consider even whether that's a take-on risk, if the risk is big enough and it might carry forward into the current, into the years that you're looking after. But sometimes, it just might be that the problems of the past are, make it more risky to look after the problems of the present. So, I think that's just something one needs to be mindful of. I'll come back to the code of conduct changes, but obviously we've got a specific rules to manage there. And the breach reporting, which we've got to have those reasonable grounds to believe a significant breach has occurred, and then we've got a positive obligation to report. But the timing of when those come in depends on the size of the relevant practice and when their particular event occurred. So. I thought this one was sort of reminiscent of someone. If you want some love, get yourself a dog. So the problems that we've got, I think, is a reflection sometimes of how, especially at the private business end, that we try as much as possible to put ourselves in the client's shoes, and we want to do the maximum we can to help them solve their problems. But there's a bit of a line to cross there about making sure that you don't make their problems your problems. It's trying to keep the distance from them. I think that's quite an important concept, but it's easier to say than do sometimes, especially where you're dealing with people that maybe are less sophisticated and they don't have a grasp of all the issues that we need to deal with in our professional lives, and they sometimes might miss it might not be a subtle message, but they miss the message as to what they're responsible for and what you're not responsible for sometimes. So it's something to be really careful of. Now, before I close and I suppose open it for any Q&A, just looking at a practical example that I recently looked at in relation to the, well, in this case, it was in the 2022 year, and to us it looked like it was a Division 7A error that had been made in the in that year, so it ought to have given rise to a deemed dividend in the 30 June 22 year, unless there was some other factors that we had not been aware of. We were just relying on what the client had given us, and there was the classic signs where the financial statements had not moved from one year to the next, and there was no interest being charged. So we had a look at this from a technical perspective, and because on the assumption that the particular tax return was lodged prior to the commencement date of the TASA changes, so that, for instance, it was, say, lodged on or before 30 June of 2024, then there isn't a specific TASA duty on the new tax agent to correct the mistake. There's no specific duty to request the client to correct the mistake under the false misleading statement rule. There's also no, even if you ask and the client says no, there's no duty to resign. And because the error preceded the commencement date of the TASA changes, the DOB-INA tax agent duty doesn't apply. So that means that the rules are as they always were, which is, while there's nothing specific, if there's time left in the amendment period, then it's best practice to ask your client to consider instructing you to amend their return to correct the error. And I think if the error is material, then or there's a sort of an underpayment of tax, well then it's something that it's worth asking for. But if the client says no, then there's not really a lot that you can do about it, and certainly you're not required to do anything about it. And of course, you're only going to be remembered for two things: the problems you solve or the ones you create. Hopefully, it's a lot more of the former. So thanks very much for listening in, and I'll pause now for any questions. So I'm not sure, Teddy, what's the mechanism there, but I'll just hand back to you to chair that.
Okay, so if anyone of you have any question, you can raise them in the chat box, or you can raise your hand and Henry will unmute yourself and you can ask the question directly.
Sorry, it's Henry here. I actually got a question. So, what happened if your peer's accountant do not provide you with any information or documentation to support the certain balance on the balance sheet? What's your obligation there?
Well, it's from your side, like the question is, what tax consequence? And I'm speaking from the point of view of tax here, not in relation to any other matters. But what tax consequence is there for the balance sheet validity not being provided? So, if it's a large receivable that relates to income that has been declared in a prior year, purportedly, then by the client applying cash received against that receivable, let's just say it's $1 million receivable, and the client says, "Oh, that $1 million that came in, that's all tax free because I paid it last year." Well, it makes it difficult to the new advisor, unless there was some circumstantial evidence to say that it was an accurate thing to say. It makes it difficult to swallow that and therefore have a low risk in relation to lodging that return. If there are other balance sheet amounts, there's a whole array of things. Obviously, it could be, but it doesn't. Sometimes it comes up, and you need to. It's like extracting teeth to get the information, but usually it's something that you convince the client to help. Have a look at the records of the prior years from that they're holding to see if you can come up with some circumstantial evidence to support the amounts that are carried forward. It's very disappointing when that occurs, because as professionals we're supposed to be cooperative with these things, even if we're not happy when we lose a client.
Yeah, indeed. I mean, sometimes. Yeah, sorry, Teddy.
Go ahead.
No, that's fine. You can go.
Yeah, so we have a question from David through our chat box. His question is, what do you do with clients who haven't got their data to you so you can lodge by 15th of May? Do I delete them?
I generally don't advise the deletion, and among other things, because of how hard it is to add them again, it sort of can be a complete nightmare. but I know that it can have an impact on lodgement programs, whatever. But like if you are lodging a return, I've actually had the question previously around this. Is I haven't got all the information I need to lodge the return. Can I just go ahead and lodge? And I actually don't think that we're meeting our professional obligations if we know that the return's incomplete. Well, then if you've got 95% of the information, you may as well only have 5% of the information. It's at risk. So as tax agents, I think we're taking risk in relation to there. But whether you wish to, delete them, that's basically equivalent to saying I'm withdrawing from the relationship. So it'd be more than just simply deleting them more than just deleting them off your tax agent list. I think you would need to do more than that, in my thinking.
Okay, so, there's another one from Sally. She was asking, do you have to recalculate the franking credit balance from the client's prior year tax return, or can you rely on the balance amount of the last year return?
That's a very good question. I think the default position, you should be able to rely on the balance in the last year return, unless you are put on notice that it might not be valid. So if it looks like that, for example, there's retained earnings of $100 and a franking account balance of $100,000, then maybe that might suggest there should be a few questions asked. But I think the default position would be, to enable you to rely on, as a starting point, relying on the previous return lodged.
Okay. That's the only two questions I've got. Anyone else have any question before we close the meeting?
Can I have a follow-up questions, Paul? Just follow up on your comments about lodging the tax returns on the 95% accuracy or the informations. I guess if the tax return do turn out to be incorrect or anything like that, what's the coverage of PI if that's the case? I mean, obviously you don't have sufficient information. Does it mean that your PI won't be reacting of your conduct?
Well, and that's and I don't work in the insurance area, so and I try to avoid dealing with avoid as much as I can dealing with our insurers. But I think that if there's any activity and nothing arises out of it because it's proven to be incorrect, then you're not going to have any loss, so therefore there's not going to be a problem. You only hear about these things when a problem arises, and then if like from a dealing with a PI insurer, if you did have 95% of the information and the reason why there's a problem is not because of the missing 5% of information, it's because of maybe an error that occurred in relation to the other information that you had, then I think that you would have a pretty good grounds to say the PI insurer, you should be supporting me in this dispute. But if it's because of the lack of that 5% that's given rise to the loss to the taxpayer, then I think that's where you'd have a problem. My chat box has come up now, so I'm seeing Charles had a question as well in relation to the responsibility of the current tax agent to ensure there is or there isn't an FTE in place. I think it is every year you should be reconsidering what you should be reconsidering whether or not whether it's a family trust election or an interposed ND election that's in place. Well, where it's within that first 4-year window, whether or not it might need to be varied or removed, and after that 4-year window, whether or not, if it isn't ideal, whether or not the FTE or IEE was a valid one when initially made. Now, how do you know? Because a lot of those situations are factual. But I'm dealing with one at the moment where it was one where, because of the nature of the parties about 5 years ago, where those parties were, they didn't necessarily meet the family control test at the first year end date of when the election was being made. So that has made us question whether or not the election was valid, and that then obviously has flow-on consequences. But yeah, we should be very vigilant when it comes to FTEs and IEEs. Just seeing Sally's question here. If the client invests in investment funds but can't provide all previous year's tax statements to calculate the gain with the impact on the cost base, what should we do? Well, again, this is one where if the information's not there, where is there some circumstantial evidence? So if this was an entity rather than an individual that generally doesn't do financials, but if you've got an entity here, you might have financial accounts and tax returns, and you might see that there's a tax difference there. So you might be able to postulate that there's, $5,000 a year of tax-free income that's probably likely to have eroded their cost base. So therefore, we will offset that. But that's not going to be, that information is not going to be available in every instance. Are there any other questions?
Any other questions? I do have a question. Say if you have a client having lots of return for the last, say, 5 or 6 years and they couldn't find the information, what do you do? So, for example, they got an investment property. Obviously, they couldn't get any more information from the real estate agent because the real estate agent's probably disappeared, gone. And what should you do as an accountant?
Yeah, it's there is an exercise that you'd go through to try to make some assessment as to what has called asset betterment. And I'll come back to that. But I think maybe it wouldn't be done. We wouldn't have done it 15, 20 years ago. But in this day and age, I think we would more likely than not take that, whatever the work was done, to try and effectively reconstruct what the income and expenses would be. We would take that to the ATO and say, look, here's the exercise we've gone through. We've done our best. And we think that due to this methodology, we're within, you know, a reasonable percentage of what the net income might have been. And, you know, we're not really sure about which years it sits in, but over that period, and this is where the asset betterment thing comes in, is you say, well, what, based on evidence of all the assets and liabilities of the client, say 6 years ago versus today, make some judgment call in relation to what their lifestyle was, finding out, for instance, whether they recall any significant gifts, any large holidays, you know, and online you can get a fair bit of information now about people in terms of investments, you know, activities such as, you know, buying and selling real estate. So you're putting a picture together as to what happened in people's financial lives and making a judgment as to what their lifestyle would be to push that up. And then the figure that falls out of that is the total net income that might be reasonable to estimate over the period. And then you need to then come up with some process to break it up between, you know, between tax years. But, you know, I haven't done one of those exercises for many years, and I shudder to think, given the way that you know, the standard with which I think we all need to, well, the ATO expects, you know, taxpayers to keep records these days. I shudder to think that, you know, how costly that would be from a time cost basis. You know, but certainly you would want to be in the position where you're making a voluntary disclosure on that, so that, you know, if you've got 5 or 6 years unlodged returns, that you're providing the ATO with some comfort that a competent person is trying to undertake that exercise.
Okay. All right. So anyone have any last question? Henry, you have any final thought?
No, that's it for me.
No? Beautiful. Okay. So thanks, Paul, for your time, expertise, and insightful presentation this afternoon. Your valuable contribution is truly appreciated. And if any one of you need any further information or any question, any other question that you want to ask, you can contact Paul directly, and I'm sure he will be able to help you further. So thank you once again for attending tonight's sessions. We hope to see you all back again in 1 month's time, and we'll be still online through our Zoom webinar. And until then, please stay well, stay informed, and stay connected. Thanks, Paul. Thanks, Henry. Thanks, everyone.
Thanks, Teddy. Thanks, everybody.